Roth conversions, what the academics always get wrong. Oh, it's so frustrating. All right, so we're going to read this article by my man Ed McQuirrie, who I think is a professor, yeah, right there, professor emeritus at Santa Clara University. Okay, I said I did this video before and I deleted it because you couldn't see the article. But anyway, I thought it was at San Diego. It was at Santa Clara. And I've read Ed before, so all good, all good. So what we're going to do is we're going to skip down here to, I'm going to show you something here real quick. So the conventional wisdom on Roth conversions, a rough consensus has emerged. If a conversion today will be taxed at a rate lower than future RMDs, it is likely beneficial. I will call this the intertemporal tax arbitrage. Pay some tax now to save more later, 100%. All right, so remember that. If the conversion today will be taxed at a rate lower than future RMDs, it would be beneficial. If the conversion will be taxed at a rate higher than current projections for RMDs, it may not make sense. In the absence of a well-grounded fear that tax rates in general are going to be hiked, that's reverting to the first scenario. If the conversion will be taxed at the same rate as expected for RMDs, then in the economic sense, the client should be indifferent, okay? And we're going to talk about what indifference theorem is. Indifference theorem, if tax rates are held constant, and the Roth and the traditional IRAs are invested in the same asset, and contribution and withdrawals occur as a lump sum, then the after-tax wealth gained from the Roth versus traditional tax-deferred account must be identical, as Bill Reichenstein, I'm not sure if he's still writing with Bill Meyer, but he's over at Baylor, and I'm not sure who Young is. All right. As doubts continue to be expressed on this score, a simple mathematical proof is offered. Look, you can't debate. Look, there's no argument that there is the theorem is, what is it called? The indifference theorem. I hate when they start using, it's a theorem. I mean, come on, man. But it makes sense. I mean, if I'm paying 35% today and 35% in the future, it's the same amount of taxation. There's no other way around that. Everything else being equal. But what I don't like where this guy writes, he goes, any analysis that purports to find otherwise must have engaged in a bait and switch. Huh? All right. Either putting a different asset in the Roth versus the traditional, using different tax returns, all that. But the indifference theorem only holds if three assumptions are satisfied. Constant tax rate, investments that earn identical rate of return over the same period, and lump sum contribution withdrawal rates. Because RMDs are taken as a stream rather than as a lump sum, the indifference theorem doesn't apply. But he just said any analysis that purports to find otherwise must have engaged in a bait and switch. So let me throw you my bait and switch. It's the weirdest thing. All right, hold on. It's the beginning of where Ed makes a mistake, because conventional wisdom hinges on comparison of a future tax to present tax rates. It is important to demonstrate that an affluent couple, or frankly any couple, doesn't matter, might indeed face a high tax rate once RMDs begin. A preliminary analysis will show that multi-million balances are required even to fall in the middling tax brackets for retirement. That's kind of odd to me, but okay. And then we're going to come down here. So he's going to say, so let me show you what's going on. So basically he's saying the idea that RMDs are going to put you in a higher tax bracket in the future, you have to have significant multi-million dollar IRAs. I'm just telling you. No, you don't. I'm going to show you why. And then he says right here, now, advisors must recognize, and clients need to be told that if you will not have peak wage earnings in excess of $200,000 as a couple, you will, and you have not allowed you to be a tenacious and prodigious saver. So, you didn't save a huge amount of money. You didn't save $200,000 a year. Then most likely you are going to be in the 12% tax bracket when you begin to draw RMDs. If you can do a Roth conversion for 0% today, you might benefit. Otherwise, you fail the conventional test that requires a tax level in retirement to be higher than the tax level on the conversion. Put another way, unless both members of a 60-something couple are 401k millionaires, their tax rate in retirement will likely be 12%. They will have last seen tax rates that low when they were students. All right, so basically what he's saying is, it doesn't make rational sense to do Roth conversions unless you have saved a multi-million dollars of traditional IRA money, tax-deferred accounts. because you're most likely, once RMDs kick in, are only going to be in the 12% tax bracket, which you're nowhere near right now. Missing the point, missing the point. So what we're going to do, elaborate on this some. Rob and Sue had to be prodigious and fortunate savers with large accumulations simply to edge them over the boundary into the 24% tax bracket while retired. In fact, it's almost inconceivable that they'll find themselves in a higher tax bracket while retired unless the tax rates go way up, which I don't expect to happen. So anyway, and then he shows us, not even basically saying don't even worry about the IRMA stuff, that to have the full consequence of IRMA, you have to have $18 million in tax-deferred accounts in terms of your RMD to be focused to get you above the high. The IRMA is the I say penalty, the increases on Medicare premium. So he's basically saying if you have $18 million, your RMD is $779,000, which make you qualify for the quadrupling of the Medicare premium stuff. I'm stunned how much he's missing this boat. It's crazy to me. Crazy, because he's just looking at RMDs. I'm like, okay. But anyway, be that as it may, that's fine, because we don't even have to go that far into it. We can say, look, we can shoot this down easy. All right. So what I want to do here is like all these guys do. A spreadsheet set up for base case. I always got spreadsheets. So let's take our trusty calculator, and we're going to say single, and we're going to go, not trusty calculator, trusty control F. We're going to find how many times he says single. All right. Single client. So basically table 2 in this table assume that both spouses are employed at roughly equal salaries. For a single client, simply divide all amounts by 2 and adjust for the lower standard deduction for the, well, I guess he says higher age 65 standard deduction for the singles. That's it. So that's what he says there. Interesting. Not a big deal. Single. All right. Neither table applies to single income case, where Social Security would be lower, the contributions would be cut in half. Okay, so that's it. That's all he says about single. A single conversion. A single Roth conversion. Single Roth conversion. Single Roth conversion. Single conversion. All right, we talk about until taxpayers are on track to accumulate more than $1 million apiece in their future tax-deferred accounts. When today's college, they'll be 65 when today's college students graduate, as long as their income puts them in the 22% tax bracket, around $50,000 for a single. That's all he says about single taxpayers. Single corporate match of 3%. And then finally, for a single person, the percentages stay the same, but the dollar amounts are cut in half. All right, hang tight. We're going to do something else. We're going to type in widow. Nothing. Widower. Nothing. Household. For nothing. So what happens? What's the mistake he's making? The infamous widow's tax trap. I don't understand why these guys miss that. He was kind of going along the lines, basically saying if you're single, basically one of the arguments he's saying is that if you're making money as a single taxpayer young, you should tax defer because you'd have to have multi-millions of assets in an IRA to get hit with higher taxes later on. I agree with that. I don't have any qualm with that. But nothing about Rob and Sue, Rob dying and Sue inheriting Rob's assets and now being a single taxpayer. How did these guys miss this? It's crazy to me. Remember, if Rob has $1 million in his IRA and he's 72 years old, he's taking off, $36,000 a year required minimum distributions. $36,000 for married filing jointly couple, just all included. We're not assuming anything else. Puts them after standard deduction of $25,000, well, I guess it'd be $28,000. It puts them in the middle of the 10% tax bracket, on the low end of the 10% tax bracket. Rob then dies. Sue inherits his money. She has a $36,000 RMD, just for simplicity, because she will inherit Rob's money, and she will still have an RMD based on her life expectancy. For a single taxpayer now, that $36,000 is still the same RMD. That's $36,000. Take away one standard deduction, $13,600. She'll be in the 22% tax bracket. Why? Because 0 to 10 is single for the 10%, 10 to 19 or something. I can't remember off the top of my head. For a single person, it's 20 is 12, something like that. And then after, and so she'll be in the 22%. Does that make sense? So Rob and Sue married, taking $36,000 of RMD, are in the 10% tax bracket. Sue, as a widowed woman, taking the same amount of required distributions, is in the 22% tax bracket. So the same amount of income is taxed significantly higher for Sue than it was for Rob. Thus, to compare Rob and Sue as if they're both going to die at the same time is foolhardy. Now, I get it. You can do that. But you doggone better explain that there is a good chance, highly probable, that Rob will die before Sue, and as such, Sue will be in the widow's tax trap. Not to say that, and just to not even consider that as part of your analysis, just doesn't make sense to me. Now, I worked with a client yesterday, husband and wife. Told them don't take any Roth conversions, do any Roth conversions. But what about the widow's tax trap? No, because they're going to live off their IRA until they hit, they're not qualifying for Obamacare stuff. So from 58 to basically 67, they're going to live off their IRA at a clip of $250,000 a year, right? Immediately, I think it's 24% tax bracket. Why do Roth conversions if you need income? If you need 300,000 or 250,000, 100,000, 50,000 to live on, and you only got one source for which to take that money, live off your IRA. In this case, actually, they're going to live off their brokerage account. There's other reasons. Every financial plan is unique, by the way. It's just as an FYI. When you watch my videos, just because I say something in the general doesn't mean it's applicable to you. Every situation is different. Point being is, you got at the end of the day, you need some money to live on before Social Security kicks in. We're going to take it from a taxable account, so we're going to take it from the IRA. Most of us have no taxable account, so we got to take it from the IRA. So if you need $100,000 to live on, and you got $1 million in your IRA, that's it. Well, you need $100,000. It's got to come from your IRA. There's no getting around that. Should you do Roth conversions on top of that? No, don't do that because you're pulling money out of your traditional IRA. Essentially, it's the same thing as a Roth conversion. You're just spending it now as opposed to saving it for later tax-free. In these guys' case, they're going to live off their brokerage accounts. That's what it was to qualify for Obamacare. Because Obamacare premium subsidies are fantastic, man. I mean, look, I hate the way it came to be. I don't like it. Don't like Obama, but here, it's the rules. Them's the rules. We just live by them. So you'd be stupid not to take advantage of the rules. So these guys, don't touch your 401k. Just live off your brokerage account so you can qualify for Obamacare premiums. At some point, the Obamacare subsidies will be based on assets, just like Medicaid is, but not right now. Anyway. Hope that makes sense. Don't get caught up in married filing jointly as if Charlotte and Josh are going to die simultaneously. Charlotte is 4 years my younger. I'm a man, and I breathe nothing but hot air on. I'm breathing all this CO2. I'm breathing it's come back on me. CO2 is going to kill me. As such, she will be a widow, and as such, her tax brackets will go way high because she's going to take the same amount of income from my deferred accounts as we would if we're both married. Because RMDs are based on the account owner. That's it. Hope this makes sense. Love to hear your thoughts. Thanks now.